Welcome back to Rich Dad StockCast. I'm your host, Denney, and today we're talking about something that most investors never learn until it's too late: how to protect your portfolio without selling. Now, markets just don't go up. We've got volatility, we've got geopolitical tensions, we've got wars and rumors of war, economic uncertainty, and when this happens, most investors panic. They sell, they lock in the losses, and they miss the recovery. But wealthy investors, they don't panic. They prepare, they hedge, and in many cases, they get paid to manage that risk. So today, Rich Dad expert Andy Tanner is here to break down how sophisticated investors use certain strategies like options to protect their portfolios and even find opportunity during uncertain times. Now, before we jump into this here, don't forget to go to stockcastbonus.com. Grab your free investing tools. If you want to learn how to protect and grow your portfolio at the same time, that's where you start. Andy, welcome back.
Del, this will be a great conversation, and it's always a good time to talk about protecting ourselves and insuring ourselves. But during wartime and times of higher volatility, even more important. Great opportunity to really consider what we know or don't know about it.
It's a very timely subject, and I want to jump into this, but before we do, stockcastbonus.com, there are some amazing resources in there. What do our listeners receive?
Yeah, right now, the headline of it, go there and get your ebook. We've got a free ebook that talks about certain numbers you can start to measure that'll change your life. It certainly changed mine and, many of our students. So go there, get your ebook, and it'll help you take action in a way that's organized, develop some great habits.
Very good. All right, so let's start here. Let's start with maybe a mindset question. Why do investors panic and sell during uncertain times, especially as you see wars and rumors of wars and headlines?
Yeah.
Why is that the natural reaction?
Well, it's nice that it is. Why it's a natural reaction. I'm not an expert on neuroscience, but we tend to feel before we think as human beings. We tend to use our taste buds before our brain cells. If you were to look at, I'll give you an example. This is a fun thing I did the other day in a training. I'm going to give a newscast, and you tell me whether it's Fox or CNN. Are you ready? Okay, here we go. We're awesome. Those other guys over there are terrible. We're smart. Those other guys over there are stupid. We are righteous and good, and the other guys over there are evil and bad. We absolutely know what policies be best, and those guys are up in the night. So is that Fox or CNN?
I think that's both, right? I think that's both,
right? So we tend to curate our news. The algorithms figure out what we think tastes good, and we opine based on what we feel about something. If there's a wedge issue, the reason you're saying what you're saying is because you feel strongly about it. I feel, and because we're emotional creatures, from a neuroscience standpoint, 4 of our 5 senses, excluding our sense of smell, go through a thalamus, whether it's hearing, touch, whatever, taste, sight. And the thalamus, routes it. And first thing it does is it says, hey, amygdala, check this for danger. And so we feel before we think. We have very rough patterns, loud noises, whatever. Very rough patterns that light us up because our bodies are designed for defense, for survival, right? Survival of the fittest. We're designed to detect threats even when they're fake. Is that a line in the grass? Well, if it's not, still I should treat it like there is and I'll survive. So it's that human nature of survival that lights us up. And so when the market gets volatile, people are stupid. They do the exact opposite of what they should do. And Warren Buffett famously said that the secret to becoming wealthy, the secret to wealth, is to simply understand human emotion, fear and greed. And he says, look, be greedy when everyone else is fearful, and be fearful when everybody else is greedy. And that's never been more true than it is today. You can take it to the bank. You can count on human beings panicking and fighting and killing each other, and because we're primal at our core. And as much as we'd like to think we're cerebral about things, a person up on Mars is like, yeah, they're just emotional wrecks down there. And the dopamine runs our lives. The cortisol runs our lives. The epinephrine and the oxytocin, that's what runs our lives, the stuff on how we feel. So yeah, you can take it to the bank that people will panic and that there'll be crashes. That's not a hard prediction to make.
I, be greedy when others are fearful. Be fearful when others are greedy. That's one of my favorite quotes of all time by Warren Buffett. And
Essentially, it's like just buy stocks on sale. And what makes them go on sale? Fear. I mean, it's beautiful. I absolutely love it. Uh, the problem is you got to get to be about my age before you can appreciate that. I think, right?
well, it's
Um,
true. It was 2008 time when that there was that big crash. That was the first big crash I saw in my adult investing career, and I thought, oh no, the world
yeah,
is over. But as I look back and I've
it's on
experienced a few
sale.
things, it's on sale. And luckily, I started investing in real estate, so I wish I would have bought more, as they always say, right? Uh, but with age comes a little bit of wisdom, and it makes so much sense the older you get that is such a true statement.
Yeah, it's like in A Wonderful Life when they do the run on the bank, and Jimmy Stewart goes in there and Potter is buying up the town. He's like, I'll give you 50 cents on the dollar. He's buying it at half off, right? He saw a sale. He says, I'll give you 50 cents on the dollar, and people sold right away, because they panicked.
Well, that's a good transition to my next question, and that's this: is how do global events like wars and conflicts, how does that impact the market?
Well, it hasn't impacted it. Speaking about, the Iran thing that's going on right now, hasn't impacted the market like it might. To be prepared for some volatility would not be a bad idea. Right now, oil prices are elevated, so my energy stocks are just, it's incredible. I mean, it is so fun, and there's so much volatility that the options are juicy. They're beautiful. So I don't know what the future is. The defining characteristic of the market is uncertainty, and unpredictability. And when you get in a time of war that could expand, I mean, what is China thinking about this? What's Russia thinking about this? Is Israel on the same page? I mean, I'm really proud of our men and women in uniform. I'm a patriot. I'm proud to be an American. I don't like to opine on war too much because I've never sent my sons into battle, and I've never gone into battle. When Vietnam happened, I was 2 years old, so I wasn't qualified yet. Um, but I will tell you this: I don't know that you talk to the U.S., we'll say we're winning this war. Well, we don't have control of the uh, Republic or the IRGC yet, the Guard Corps. We don't have Strait of Hormuz ironed out. I mean, we don't. There's 450 kilograms of uranium. We don't know where it is. So essentially, Iran can still fire rockets. We haven't got them all. They still can control the strait. They can control the price of food and gas. And we have to see it die if we're going to put boots on the ground, to try to win. For them, win is survival. Um, they Trump says we've won. Well, it ain't over till the fat lady sings. Maybe she's warming up. I have no idea. I'm not a military strategist, but what I do know is to be prepared from a market standpoint. That I do know. We have a class called Armor, Advanced Risk Management Opportunity Readiness, which helps us exploit these situations if it turns south. So I'm waiting and watching my VIX. We could talk about the VIX in a minute. But yeah, the war and there's a lot of other factors, just the war, that can put pressure on a market. And then you got AI pushing it higher. So we have these opposing forces. It's really fun right now.
So what do wealthy investors do differently during these times of uncertainty?
Yeah, Robert wrote a book called The Unfair Advantage, and he was really gracious and invited some of the people in our group to contribute. And he asked me a question in that book, very similar to what you just asked. He said, "What's the difference between an amateur and a pro when it comes to protecting?" And I said, "Well, I'd say there's two main differences. On the income side, amateurs go for capital gain. They try to buy low and sell high, where investors prefer cash flow, a cash flow pattern on the financial statement that shows an increase in cash flow, or what we call net income, earnings, bottom line, whatever you want to call it. The other one is, and so that's the first difference: capital gain mindset versus cash flow mindset. And then I'd say the second difference, maybe even a bigger difference, is how they address risk. Amateurs do it through diversification, which Buffett says is just a revelation of, it's an admission of ignorance is really what it is. It's a revelation that they don't know how to choose companies. They just buy the whole thing, and they just basically say, I want to be mediocre. I want to be average, and whatever the world gives me, I'll take. And, they just take themselves out of the equation. That's what amateurs do. They diversify, which takes zero intelligence, zero financial education, zero company evaluation, zero fundamental analysis, all that stuff out the window. They just buy the whole thing. The pros, they manage risk through contracts. They create contracts of all shapes and sizes, derivatives, if you will, that help protect themselves. And we have any number of hedging strategies we can use: protective call rights, protective puts. We can use stock as a hedge if we want to delta hedge. We could use options as a delta hedge. We could use futures as a delta hedge. So what we do is we use contracts to manage this. So think of it this way: if you have a house, how do you control the fire? Well, you can't. You put in smoke alarms best you can, put in an extinguisher in the kitchen, but fact of the matter is they can still burn. So what do you have? You have a contract with an insurance company that says, if this bad thing happens, we have a crash or a burn down or meltdown, your car crashes, your house burns to the ground. Well, the market can crash and burn to the ground. So why don't people do what Mark Cuban did and use options as insurance policies to protect themselves, and even opportunistically in times of trouble? When the VIX is high, selling options; when the VIX is low, buying protective options. A lot of different specific ways. I don't want to get into too much jargon, but if you look from the big picture, when it comes to wealth building, it's cash flow, not capital gain for the pro, and it's not diversification. It's using contracts and insurance. That's the big picture.
Can you speak a little bit on what the VIX is? We've talked about a couple moments, and I just want to define it if we can.
Yeah, the VIX is a great tool. There's probably nowhere you could go to get a better understanding of fear and risk than the insurance industry. So, for example, if you take a guy like me, a bit of a lead foot, I like getting places. I need to do a lot better at adhering to the speed signs. Where someone like my wife is going to be more conservative in how she drives, right? So an insurance company looks at a guy like me, how I drive and how she drives, two different risks. And so maybe the teenager who has a sports car and who's young and has a couple speeding tickets already, their premiums will be higher. So insurance premium is a fabulous gauge for risk. Health insurance for me, it's tough because I'm a cancer guy, right? So when someone calls to sell me insurance, I say, yeah, I have cancer, and they hang up. They don't even finish the sentence, right? Don't want to insure that guy. And so the premiums bake in where the risk is. Well, you can buy insurance on the S&P 500. You can basically say, what does a put option cost for the S&P at various strikes and expirations? Those prices of that insurance, the fear that is expressed in those prices, gets put into something called the volatility index, VIX, volatility index. We call it the VIX. And it's basically a reflection, an index of fear. How much are people willing to pay to lock in benefits of the S&P, where if it crashed, they would be protected? So it's just like, if I see there's fires in the neighborhood and I want fire insurance, it's going to cost me a lot more to get it if my neighbors in California are already on fire and I'm trying to get the insurance now during the fire. Insurance is expensive because there'd be a lot of fear there. But if you buy it when things are calm, well, you can get yourself a great deal on the insurance. So the VIX does that. Once I see a VIX really, really low, like in the teens, 15, 16, I'm going to spend a small amount of money that I'm just going to burn like insurance. We're going to say, take that hit, burn it, and hope the VIX stays low. But I'll tell you this, when those options on the VIX spike, a spike in the VIX from, say, 16 to 30, that's a doubling of the VIX. S&P only needs to move about 5% to have that happen. in a day. And so you can really clean house on that stuff. You can really do well. So that's that.
Great. Thank you for sharing that. I want to make sure we define that a little bit, add some
VIX
context.
is the fear gauge. Yep.
The fear gauge. All right, let's do this. Let's take a quick break. There's, volatility isn't the enemy; it's a signal. And for prepared investors, it can actually create opportunities. So when we come back, Andy's going to break down how to hedge like the wealthy, how to protect your portfolio without selling, how to position yourself during uncertain times. And don't forget to go to stockcastbonus.com, download your free resources. That's where you really start building real investing skill. Stick around. We'll be right back.
So far, it's been great. I needed a source where I could really enrich my education through stocks. I didn't really have an avenue for it, and it's helped me a lot. The simplicity has really gotten me on the track to where I enjoy the learning as well as it's really solidifying in my mind. And like, they're not just trying to sell you something, they really care about the people that are in the course, and they really do care about you and your personal goals, and what you want to do is to help you and your family and whatever your goals are in life through that. So it's really been great.
Welcome back to Rich Dad StockCast. All right, Andy, let's get practical. There's a term, delta hedging, that is probably worth knowing. Can you explain to our listeners what is delta hedging? Why does that matter?
Yeah, maybe I should talk about when I would use it before I talk about what it is. So some games are really fun to play in, and other games turn to garbage. And when I play basketball, maybe the first pickup game's pretty good. Guys are fresh, everyone's running, everyone's playing defense. But as the day goes on, guys get tired and it turns to crap. No one's playing defense. Everything's a fast break. And when it gets degraded like that, I say, I don't want to play anymore. I don't want to try to win, and I don't really want to. I'm not going to win. I'm not going to lose because I'm just not going to play. Well, the problem is when you look at the market and you decide you don't want to play. It's just not a good game right now. You want to play. Well, if you liquidate everything, you're going to have capital gains tax and, messes, and then, buying back in, it's a mess. So one of the things delta hedging does is it lets me say, you know what, I don't want to play right now, but I don't have to sell anything. I can put my portfolio on pause, and I can freeze it where it is. I can protect it and make sure it doesn't lose a dime, and just freeze the value of those assets with a hedge. So that's when I would do it. If I look at the market and I think, this thing isn't worth, I don't want to speculate. The risk is really high, the rewards are really high, but this is not a market I want to be in. I just want to lock down and preserve my net worth to where I say my net worth tomorrow will be the same as it is today. 10 weeks from now, same as today. And then the other thing is, if you sell all your assets, you lose your cash flow from it. So I definitely, if I look at the market, say I don't want to play, well, I don't lose my cash flow, right? I want to keep those stocks and the dividends keep coming, but I don't want to play the up and down game. So how does this work? Well, I'm going to date myself, Del. In the 1980s, I think it was. So we're going way back here. In the 1980s, there was a movie called My Bodyguard. And it was a story of this little punk kid who's getting his lunch money taken to school. He's getting beat up, and they take his lunch money or whatever. He's a high school kid getting beat up. And so he goes and he finds the biggest, toughest, this kind of loner kid in the school. He's kind of a loner, kind of shows up to school half the time because he works at a steel mill or something. And he befriends this big, strong dude and says, look, rather than paying these guys my lunch money, I'll give you some of it if you can protect me, and then I can at least have some lunch money. So this guy becomes the bodyguard, and sure enough, it's an equalizer. Now, the reason I bring that up is it's really important to know the power of a bodyguard. What a bodyguard is an opposing force. So, if you show up to the fight and the guy's bigger than you are, you employ a bodyguard. Go buy a bodyguard, and then it's an even match. So that's what delta hedging essentially is I'll look at my portfolio, maybe as a aggregate. We can go through this and kind of do what we call beta weighting and kind of see what the overall, delta means, which means with a 1-point move in the market, how does Andy's portfolio move depending on his mix of stocks? Am I more aggressive than the market or less aggressive than the market? What is that delta? And I find out what that number is, and I buy an opposing investment. For example, maybe I buy a future that has a delta equal to my portfolio. That means if my portfolio goes down, that future would go up dollar per dollar. And so as that, with that opposing investment, with every dollar I lose in the portfolio, I gain in this other investment. It goes like this. So the net result is equal, right? If this goes up, this goes down. If this goes up, this goes down. And it just puts an asset on the whole thing and just levels it. But the nice thing is I can still write calls and I can still collect my dividends. My cash flow is uninterrupted, and I don't have to pay a bunch of taxes by liquidating. I can just keep it really even right there. So that can work out really, really well. There's many ways to delta hedge, lots of different strategies we teach, but essentially it's, look, I don't want to fight this fight on my own. The guy's too scary right now to fight on my own. I'm going to hire me a bodyguard of equal and opposing strength, and I'll just let those guys neutralize each other and kick back and wait for this market to settle while preserving my cash flow each month. So that's delta hedging in a nutshell.
I love that, and I love the reference to the movie. I've never seen it, but it made sense. It took a complex idea,
movie, dude. It's an '80s movie. It's rough. I mean, it's called My Bodyguard, and it's not worth watching.
I think we need more '80s references. If we can put a few more movie quotes in there, that'd be great.
Oh boy, I'll tell you.
So let's talk about hedging. Let's talk about options a little bit more. How can investors actually get paid during uncertain markets when there's
you could certainly speculate. One of the we mentioned this in the first half is I love Corey Halliday, one of our main trainers here, great risk manager, Series 4 option principal, just great risk manager. He loves that VIX trade where you can actually buy a call on the VIX, because when the market goes down, the VIX goes up. And it's interesting because I mentioned earlier that it's disproportionate, just like insurance. The payout of insurance, if you need it, is much higher than the premiums, isn't it? That's why you buy it, right? That's the whole reason. So that insurance contract that's costing you whatever it is a month, few hundred a month, becomes worth millions when the house burns down. It's asymmetric warfare, right? So the same thing happens with a nice fixed call. You buy a little, or even a call, even a vertical spread where you don't, you sell the upside, buy a little bit and you just buy a section, so to speak, with a vertical spread. That can be 1,000% return in a crash. Like bang, it can. Because the VIX is so much more movement to a smaller S&P move. And then you've got 100x leverage on your options that you bought. So that's one way you could do it. If you're smart enough to pick up a little bit of VIX insurance, that's an expense that usually expires worthless. But we're talking pennies. We're talking pennies to buy these, not even dollars, pennies. But once the VIX is high, you're not going to get it for pennies. It's going to be expensive when everything's on fire. You can't buy fire insurance during the fire. Here, fire sale. Hurry up, it's going fast. You don't get to buy car insurance during the wreck, right? When your airbags are going off, you don't have time. 15 minutes could save you. Well, you don't have 15 minutes. You just don't. So there are different strategies. I will move from a VIX play to an S&P put play sometimes, or I can use individual puts. We can collar a stock where we do what Mark Cuban did and sell some out of the money calls to buy some protective puts. It's called a collar. That'll freeze it. That'll put an asset on it and just lock it up, freeze it. There's a lot of things we can do. As I said, specifically, probably beyond the scope of the podcast, but from the big picture standpoint, just think buy insurance. And insurance is worth buying a lot of the time. If someone's house burns down and they say they didn't have insurance, you don't say, oh, they're there. You say, well, dummy, house is burned down. Why don't you have insurance? Well, I can say the same thing about 401ks. What's more likely to burn down during the Iran conflict here? Your house or your 401k? Which is more likely to burn this summer? So learn about insurance.
Very true. Now, speak out of, like you said, there's so many avenues we go down. This would be a very long podcast, but going to action items. Action items are so important, right? With not just the consuming education, but taking action. If someone wants to start protecting their portfolio and looking for opportunity, what's the first step they should take this week?
Well, we learn before we earn. So that's the first step always. If we try to do something we're not familiar with, that just adds more risk, right? If I'm a first responder and I show up to that emergency and I'm not trained, I'm just going to make that emergency worse, right? I'm not going to take care of that patient. Things are going to get worse. Might even put myself at risk. So learning before we earn when it comes to risk management is a really tough sell. So I don't try to sell it. I'm too old. I used to say, hey, everyone, you should get ready for this, and that, and the other. Like the COVID crash, everyone comes and calls. Andy, what should I do? What should I do? I was like, well, you're asking me now. You should have had insurance 6 months ago, right? You should have done things. Well, tell me how to protect all this. It's above your pay grade. You don't know how bodyguards work. You don't know what deltas are. You don't know what beta weighting is. You've never practiced can you imagine a police officer going into a SWAT team situation with no training, and it's their first rodeo on the first time? They get shot. And so it's really critical for the first step to learn. If you want to learn advanced risk management and really capitalize and see the opportunities for profit from a downswing, check out our armor class. Now, I'll warn you, that class, I shouldn't sell it because it's not for everybody. You really would have to even have a baseline of basic knowledge before you even took that class. But learning by far, practicing, having a pay-per-trade account, and being familiar with some of these instruments before you have to do it under pressure when everyone's fearful and you want to be greedy, the knowledge has to be there as well as the temperament.
Oh, very good. Thank you for sharing that. Let's wrap up. Listeners, markets will always have uncertainty. There's always going to be fear. There's always going to be headlines. There's always going to be volatility. But the difference is how you respond. So you can act like the average investor, or you can prepare like the wealthy. And a big thank you to Andy Tanner, as always, for breaking this down, making maybe complex items very simple. So thank you for doing that, Andy. And listener, if you want to learn how to hedge your risk and build confidence in any market, go to stockcastbonus.com right now. You'll find free tools and education there to help design you to invest with discipline. And if this episode brought you any sort of value, make sure you like it, subscribe, share it with someone who needs to understand how to handle volatility. You're not here by accident. You're building something that most people won't. So stay smart, stay invested, and we'll see you next time.
Thanks, Del.
This podcast is a presentation of Rich Dad Media Network.